In this episode, Ryan and I discuss some of your concerns about the infinite banking concept given the current bank run crisis. We had fun and hope you enjoy listening. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
And I'm your co-host, Ryan Griggs.
Here we are on a beautiful Saturday morning in March.
A cloudy Saturday morning. Cloudy Saturday morning.
There's sun shining above the clouds.
Okay.
So what do you want to talk about, Mr. Griggs? I know you had an hour drive over here and you got all geared up on something.
Yeah, and I was up early this morning too, thinking about it. I've had a few clients ask recently whether the recent bank runs in the U.S. on Silicon Valley Bank, Silvergate, and to some degree Signature, although it's not quite clear that the circumstances are similar there, but to what degree bank runs affect life insurance companies, life insurance policies, and individuals' security and their comfort level, So obviously this has to do with IBC. And I don't think it's going to be very widely discussed in the broader IBC footprint.
You don't?
No. So I figure we might as well say something.
There you go. I've had a few conversations over the last week, and typically it's like, well, I've got, more than $250,000 in the bank. Should I move it? Should I be concerned? And then don't the life insurance companies use banks?
Mm-hmm.
And, then the guarantees of the different types of accounts, the all-American average, individual owns, and who guarantees those and what backs those guarantees up.
Yeah.
So
I have a few initial thoughts. I mean, one, my broad response is like, this is one of the reasons we do IBC. This is one of the reasons systematic capital accumulation inside of permanent whole life insurance from a mutual company is advisable, is because of the relative security in a life insurance company compared to that of a particularly small and medium-sized bank. And so there's even layers within that, right? Like what we're doing is capitalizing. We're systematically accumulating concentrated financial value. This isn't banking per se in the sense of having money in a checking account and building up ostensibly perfectly liquid demand deposits at a commercial bank. That's not what we're doing. And there's a lot that could be said there, right? Like a lot of the conflation of, like, we get it. Nelson used the word banking in IBC, like, okay. But a lot of the conflation online in the marketing references to policies as accounts or premium payments as deposits. Like they're not that. They've never been that. And for when people like me or you point that out and say, stop it, the accusation is we're just, finger wagging and it's just semantics and, you get what I'm saying. And it's like, well, no, how about let's have a banking crisis happen and then suddenly we might care about the meaning of words again. So it's curious how that happens, right? Like we like to have it all both ways. The language is amorphous enough and we can use the terminology of conventional finance to make it easy on somebody so they can get it easier. But then suddenly a banking crisis hits and then maybe clients who have implemented IBC want to know if what's going on in the broader economy is going to affect them. But those advisors don't provide service anyway. So maybe they're never going to answer the questions in the first place.
So then you get all your news from the news, right? All your up-to-date information from the media outlets that, that's 100%.
Yeah, so no wonder people are concerned. So in
the broader view, my response, broadly is this is part and parcel of a fractional reserve banking system, period. Bank runs, bank crisis, whatever the genesis of the crisis is, it's part and parcel of fractional reserve banking, just like the boom bust cycle.
Yeah.
You can't separate them.
You can't separate. And I had to have a client ask me, one particular concern was, well, these life insurance companies must have bank accounts.
I've had that same question,
Yeah. So could there be a problem for the life insurance companies to get access to cash? And the answer to that, I think, has to do with what particularly happened with the bank runs in early March of 2023, the kinds of banks that were affected, and the reasons those particular banks were affected. Like Silicon Valley Bank, probably I think the largest of the three, right? Silicon Valley, Silvergate, Signature. Silicon Valley Bank was, I think, once it collapsed, was the second largest bank failure in U.S. history. Prior to the receivership and eventual disintegration of it, was a top 20 bank in terms of capitalization. So a substantial financial institution, but in the context of banking per se, was what would be classified as a small to medium-sized bank, right? Compared to your JP Morgan's, Bank of America, Wells Fargo, Citi, giant conglomerate behemoths. These small to medium-sized types like SVB, Silvergate, and Signature, like other small and medium-sized businesses, did a lot of activity with loans to corporations. And these three banks in particular primarily served venture capitalists and players in the cryptocurrency and technological kind of space. So that produced industry risk, right? A high concentration to a particular type of clientele. Now, what led to the ultimate bank run? Like at SVB, these venture capitalists, clients of SBV, started telling their in the firms in which they had invested to pull their money and change accounts. And what had precipitated that, as we come to find out, the SVB has been bonusing out a lot of its senior management. But of course, this traces back to FTX, right? So the giant financial fraud that was FTX is exposed. This causes fear and concern among the crypto community. A lot of those individuals go to their exchanges to pull funds. Those exchanges, many of them had accounts with SVB. And so you have a lot of exchanges, I think over the course of like March 13 and 14 in particular, pulling a lot of their funds, sort of the first digitized bank run where you don't have to go line up outside of the bank door. You just punch some code in or even have it done algorithmically. And these funds are pulled from SVB. And so that starts the drain on deposits at SVB, right? And then in the background, since March-ish of last year, 2022, you have the Federal Reserve hiking interest rates at a faster pace than ever before on a percentage basis. And come to find out that it's a little known fact for some of these tech firms that bond prices move inversely with interest rates. Well, going back a bit further, when interest rates were still in the dirt, and companies were flush with deposits, they had to find somewhere to put this money. A lot of them put it into long-dated treasury bonds. And so you've got companies like SVB with a bunch of treasury bonds, and then you've got hiking interest rates that forces a discounting of those bond values by somewhere in the neighborhood of 15 to 20%, producing a whole lot of unrealized losses on the books of these companies. And then you've got this external sort of exogenous event, this FTX thing happening. This causes a drain on the deposits of this one particular bank, SVB. And so the company now has to realize those losses. They have to sell assets in order to meet those demand deposits. And in the shuffle, they run up against FDIC minimum requirements for capitalization. Right? Banks have to have so much capital in order to meet essentially calls on liabilities. Right? And if you hit certain thresholds, then FDIC receivership is automatic. Right? And that's kind of what happened. And okay, so that happens. And then you have this idea of contagion that happens with SVB. Well, then the concern becomes, and I was talking about this on Facebook late last week, to what degree were the underlying causes that led to the SVB collapse affecting other banks? Well, to some degree, it affects a lot of the small and medium-sized banks because a lot of their banking activity is in loans, corporate loans, business loans, small business loans, mortgages. Whereas for the uber large ones, the sort of people who sit at the front of the table at the banking cartel, JP Morgan, Wells Fargo, Bank of America, Citi, they're flush with treasuries, a lot of high quality capital, relatively more liquidity. Whereas these small and medium-sized banks have a lot of outstanding loans to commercial entities, to corporations. The timing of repayment for which is relatively less certain. Okay, so if I'm now a small or medium-sized bank and there's general fear about the security of bank deposits, and then you have the Federal Reserve come announce this bank term funding program where they will promise to lend to a banking institution so long as that bank can produce certain kinds of collateral, right? Treasuries and mortgage-backed securities and agency debt. Well, that's not what a lot of small and medium-sized banks hold. So what do you have? You've got Kevin Leary going on Tucker Carlson talking about how all of his special friends, Kevin O'Leary, it's funny because Kevin O'Leary was a big participator in the FTX scam, but anyway.
Yeah, Mr. Wonderful?
Yeah, it's how wonderful. You have this outflow of deposits from small and medium-sized banks into the large, big, cartelized banks, right? JP Morgan and so forth.
Big pop.
Okay. All of that is to say, who do you think your life insurance company banks with? Okay. These large financial firms are not keeping bank accounts at, mom and pop Main Street bank. Yeah. They're banking with the big players. So the response to the client who asked me the question about whether the life insurance company can get to capital on the fear of bank runs, the response is it's not the case that all banks experienced a run. You have to decompose what we mean when we say bank in the context of bank runs in 2023. The relatively endangered players were the small, and still to some degree are, the small and medium-sized banks. And then of the small and medium-sized banks, it's the ones who had especially bad interest rate management, right? SVB had no risk management officer for 9 months out of the year in 2022. No risk management officer at a bank.
No hedging.
Yeah. So no hedging, and none at all. Not like just bad, just none.
Yeah.
So the poor risk management, poor interest duration risk management, industry concentration, and then on top of it, a lot of the accounts at the bank were in amounts in excess of the FDIC insured limit of $250,000 per account. So there's this confluence of, I think one way I put it on Facebook was that there's this spectrum of circumstance for banks. Like what you said, and what you said underlies all of this, right? That fractional reserve banking means that all banks are inherently insolvent. That is true. But in that context, there are some that are more fragile than others. And the ones that are especially fragile happen to be these players where they had little to no risk management, industry concentration, and account balances in excess of FDIC limits. And those were the ones on which the run was perpetrated. There is further speculation, and I point to Caitlyn Long of Custodia Bank. If you go look for her, she did an interview on a YouTube channel called Blockworks, which is really wonderful, where there's some additional speculation that this was all coordinated to target those banking institutions that were explicitly serving the private crypto community space on speculation that there's an implicit insidious consolidation underway to extinguish private cryptocurrency players in order to pave the way for a centralized federal digital US dollar. But that's a whole, we can get into that to the degree you want to, but that's a whole separate side to this, right? Anyway, What matters for our point here was that I know you're getting mad because I'm talking so much.
I'm not getting mad. I'm just looking at how much time I might wind up with.
yeah, same thing. What matters is that these life insurance companies aren't banking with your local mom and pop bank, right? And have often over 100 years of practice at managing interest rate risk. So, yeah, that's the first phase of my response to the question of what if can the life insurance companies get access to money?
And your response, I mean, that was eloquent and very comprehensive. And I think that in addition to some of the things that they didn't do well, would potentially maintain their relationships. You got all the venture capitalists, hedge funds keeping lots of deposits in your institution, and those relationships go wrong to the point that they tell their clients to pull money.
Yeah.
Like, ooh. But then again, with the and I listened to the part. I think he posted something on Facebook, and the young people were talking about the crypto and the different things. I found that very interesting. But it maybe, and then from that perspective, maybe their relationships were just right on point. Maybe they are trying to crush, some of these crypto banks. Who knows?
Yeah.
I don't know.
Well,
but there's absolutely more than one narrative going on. It's not any one causation. It's a confluence of several things that just circumstantially happened. Mm-hmm. Yeah, no.
Yeah.
No.
Well, this is what the march of centralized, politicized, governmental monetary control looks like, right? And tyrants double down, right? The Pharaoh cracked down, he wouldn't.
Look, man, they're rioting in France right now because they're moving the pension age up. And it's like here in America, we're just sitting there watching it happen. This is just another example of what we're watching happen. It's like the FTX debacle and collapse and all the money laundering, slush fund, money flowing freely throughout that entity. I'm sure none of that was involved here with SVB.
Well, we know FTX or Sam Bankman-Fried had like $10 billion with SVB. So they are certainly related. I think this particular episode is like, under the guise of financial crisis, definitely an opportunity for the powers that be to quash or to further squeeze decentralized players, right?
Absolutely.
The small and regional banker, the private crypto.
Driving money to the big banks, there's no question.
Yeah.
Controlling the crypto, no question.
Yeah.
I mean, no question. And then rewarding the appropriate players and crushing the ones that they want to crush. So it's a good old boy system. And when you're in, you're in. And when you're out, you're out. Mm-hmm. You know what I mean? So even within all of that's going on, their players are getting paid big money. Did you reference before we turned on the mics that bonusing at SVB?
Mm-hmm. All the way up to the morning of the raid on Friday.
Wow.
Yeah.
Here, I got to get this money out of the system. And so there's a lot there going on, and you can put a tinfoil hat on me if you like, but none of that happened in a vacuum. Every bit of it was constructed, and then they just take advantage of the timing and create the timing, create the opportunities. But it's like the idea that, and I've seen all kinds of numbers. The SVB had $200 billion in assets, but they couldn't redeem $20 billion or $2 billion in capital calls from runs, and they're selling their bonds at a discount, right? Because interest rates have gone up. That's 1%. It's like, wait a minute, I have $200 billion in assets and I can't handle a 1 or 1.5% cash call in essence. I got to sell these at a discount, take my loss and go on. Yeah, that doesn't make sense to me.
There was a big outflow of deposit. I think in like one day, like 47% of demand deposits were pulled.
Wow, that is a lot. 47%.
Yeah, it was a lot, and it happened very fast, almost like it was coordinated. I mean, the that initial 12 or 15 minutes or so, I mean, I don't expect that to be enough to like convey what all has happened. A great follow on Twitter is at Lynn Alden Contact, LYNALDEN Contact. She's got that March newsletter that's currently pinned, gives a great explanation of the nature of the liquidity problem right now that led to the bank runs. And then she did a interview on, it's called the Blockworks YouTube channel. And I'll find it at some point. But there are a couple good podcasts on that network, Forward Guidance and On the Margin. And there have been several appearances there recently that help a lot. I've shared some of them on Facebook, all of which is like public. So even if you're not a friend, you can go and find it. Yeah, this is called Bank Runs, Set the Stage for Financial Repression Endgame. And that's Lynn Alden on the Forward Guidance podcast on Blockworks on YouTube. But anyway, so my point is there's other resources out there to get like the full rundown. Patrick Boyle on YouTube as well also gives he's a good finance alt-fin commentator, finance professor on YouTube. So you can go to those for more information on exactly how that all played out. But my point here is like addressing the implications for IBC and life insurance. Because there's another consideration, right? Like if the problem at these small and medium-sized banks was that their bond portfolios plummeted in value, well, isn't it the case that the primary asset on the books at life insurance companies are government bonds?
Corporate bonds, long-term, high-grade corporate real estate, but yeah, bonds of all durations, no question.
Yeah. So I haven't received this question, but I could see it coming. Is okay, well, what happened? Could the same thing happen at a life insurance company as is happening to some small and medium-sized banks? Namely, could the value of their bond portfolio fall sufficiently to cause liquidity concerns, or worse, to cause a life insurance company to run into minimum capital requirements? And could that then trigger some sort of automatic receivership or state commission involvement? No one's asked me that, but it's okay to preempt even the most severe of types of questions. Do you have any thoughts on that? I do.
Sure do.
Do you want to share them, or do you want me to go?
No, just keep going. It's I have thoughts and comments, but keep going. Yeah, could it happen?
Well, anything could happen, number one. And in some sense, we have to acknowledge that there's no perfect solution, right? At the end of the day, the monetary system is what it is. Bretton Woods is over. The federal debt is ever increasing. Deficits are ever expanding. Money supply creation is ever increasing, except for a brief window of quantitative tightening, which is now closed. So like these problems are ongoing, and they absolutely do put pressures on companies that need to generate a yield in order to make good on long-term liabilities. My thing is that there are a few differentiating elements that separate mutual life insurance companies from these banks. And it goes back to where I kind of started off with, which is that life insurance companies are not banks. I mean, it sort of makes it's not funny, but it's ironic that recently we had Mass Mutual come and complain about some bad actors in the business making whole life look like something having to do with banking per se. Like hiding the fact that doing IBC meant getting whole life insurance. It's like whichever players were doing that, whichever agents were doing that right now in the midst of these bank runs, like it might be good to start telling people that, oh, this is actually life insurance. It's not a bank account. Right?
Whenever you buy life insurance, generally most all of the companies participate in LIMRA. I think it's a life insurance. I don't remember the acronym. Life insurance. Marketing and Research Association or something like that, right? And so they provide an awful lot of data to the general public and to mainly the life insurance companies. And I was thinking about that since you brought up Mass Mutual, that when you buy life insurance, you generally, and even, look, whether you're buying life insurance, annuities, and maybe you get it when you buy health insurance. I don't really recall that, but life insurance or annuities, if you purchase that in America, you will get typically a survey from LIMRA, like grading the agent, giving a commentary, on the agent, the insurance company, the expectation, and then the purpose in which you purchased life insurance. And they give you, 10 or 12 boxes to check. A couple of those boxes have to do with future retirement income. So, and I'm bringing that up because Mass Mutual is like, oh, you can't sell this as it's positioned as a retirement account or retirement investment or whatever. When in fact, and there's some other egregious, and I'm still working on my commentary for Mass Mutual. Okay, traveling, and it'll be good. There's a couple of errors in that Mass Mutual memo. One of them is that talking about life insurance being presented as retirement. When the industry data collector and provider for the insurance companies has a box on there, did you purchase life insurance for this reason, this reason, this reason, or this? And a couple of those reasons are future retirement income. So are you telling me Mass Mutual never, ever, or doesn't currently consider life insurance cash values as potentially as supplemental income in retirement? It's such a joke.
Yeah.
But look, whenever you pay a premium to a life insurance company, is that an asset or a liability to the company?
You're asking me? Premium's income.
Is it an asset once it's paid to the company?
The cash is.
Yeah, absolutely. Perfect. So if I make a deposit in a bank, is that a liability or an asset to the bank?
It's a liability.
Perfect. So, and then a life insurance company can't inflate, right? They can't inflate. If I pay, $100,000 in premium, they've got their expenses and net of that. They've got to put that capital to work. That's where they put it to work. And bonds, government, high-grade corporate bonds, high-grade corporate real estate, varying durations. And they're going to manage that whole portfolio over a theoretical life expectancy of 120 years. But they can't inflate. So the bank can inflate, and we all talk about this 10-to-1, like if you pay you have money on deposit in the bank. It's a liability to the bank, but they can leverage that liability 10-to-1. Oh no, banks are much, I don't know what the latest data is. I'll have to talk to Barry Dock to find out what the latest leverage percentages are. But I assure you, SVB and all those other banks were leveraged much, much, much more than 10-to-1.
Yeah. I don't. My understanding of banks currently is that they're flush with deposits. Like, if there was a meaningful reserve ratio requirement, it wouldn't matter because they have so much on deposit right now. Partly because of fiscal policy, all the stimulus that.
Well, that's why they're flush. I get it.
Yeah.
But they're still leveraging.
Sure. Yeah. I just don't know to what extent.
I don't either.
But your underlying point of life insurance companies are not banks. Like they're
not.
The fundamental accounting of what the cash flows are is absolutely distinct. Your premium payments are not checking account deposits. A policy loan contract creates some degree of illiquidity. Right? It's not as though you can go swipe a card and pull money.
You mentioned earlier in the beginning, which was, there's a lot there. It's like the infinite banking concept is the intentional, continual formation of capital. It's like we're building capital over time, right? So, and then, and I think that's overlooked somewhat, especially when you get into the short-term thinking. And the way, so broadly, I prefer personally to do business with local regional banks. I know where they invest, and I mean, I can read their balance sheet that they provide. I mean, not that I know every integral detail of the bank, but they're local banks. I know where they invest locally and things like that, which that gives me a certain level of comfort. But the consistent building of cash value through premium payments over a longer time period, I don't have a short timeline. I'm not looking at this year, next year only. Of course, I'm looking at this year, next year. Can I pay the premium? Does it make sense for me? Is it, doing what I'm supposed to do, or is it doing what I want it to do? Am I going to have the capital to do what I want to do and not be dependent upon the third party lender and not be part of the problem? Although I think today, when the individual goes in, and the money, the digits don't exist in the bank until I sign my John Henry. That is the beginning of the creation of the money. Right. So I'm part of the problem when I do that. Now, I didn't wind up being dependent on a bank overnight or credit cards, and nobody else did either. Right. It takes time to work your way out of this debt slave construct, in my opinion. So I don't want to be part of the problem. But whenever you have this politicized, cartelized banking, one has to wonder how much of my activity, if I go borrow money for a mortgage or a car, how much am I really adding, to the problem of banking whenever they use these banks as slush funds and they leverage the fire out of them. And they absolutely are controlling the outcome, in my opinion. I don't want to digress too far, but you said earlier, the systematic accumulation of capital. Right. And so, broadly, there's a lot of narratives going on. But at the you and me level, what I see is, and it's over the last couple of weeks too, I've seen it where, people are sending me illustrations, and I do not ask for illustrations. If you, and I don't want to armchair quarterback whomever you're in a relationship with when it comes to, financial advising or life insurance purchasing. But let me say I'm a capitalist. We get new clients every day. Okay. But what I have seen is this hyper need to front end, quote unquote, load or pay a really high premium into a life insurance policy in the first year or two. Right. And then, that you're really taking a life insurance policy and manipulating the fire out of it to have a high cash value. Maybe you're trying to illustrate a high internal rate of return as well. And it's like, well, you got to get the money out of the banking system and get it over here. You've got to immediately pay, 100,000, 200,000 or 50,000 or 10,000, whatever it is in year one, and then pay pennies in year two and beyond. Like, then you've got to put all of that capital to work to properly, and then call that infinite banking, or that's how you do it. So I'm just saying that I have seen recently where the people are being agitated, there's a bank failure, there's this and this and this, and look at this, and what is your life insurance company doing? What are they rated? Where do they put their money? How much capital can they get to? Aren't you worried about your cash value? Here, how fast can I get a policy issued and get all this money in there to get it protected? Where it's the protection in life, there's limits on protection to each account that we put our money into, right? And so, yeah, I can stuff all that money into a life insurance policy, but I'm paying for that privilege. And then what does it really do over the long term of that policy? It might not be in my best interest. Yeah. And I'm exceeding the limitations of, guarantees. And we can talk about guarantees of a life insurance policy.
Well, those people who advocate that, and there are plenty of them.
They're online, everywhere.
Yeah. Are not helping anything.
They're not.
Right. When you go to a life insurance company, want to pay this big old outsized premium year one, year two, and then throttle it back down. And you're going to do hyper loan activity, right? Can I get a loan right away? And then build a little more cash flow. Go get another loan right away, right? Okay, so what causes the in some sense, what is the bank run at the small and medium-sized bank? Well, it's when a bunch of depositors want to take money out of the bank. All right, now there is no direct analogy to the life insurance industry, but a close relative of the mass, deposit pool is a bunch of loan activity. I mean, that at the end of the day is a distribution from the company, right? It's the life insurance company having to provide capital to a customer that has a contractual right to it.
Life insurance company's capital, not yours.
And let's not jump over that, right? Like one of the risks that life insurance actuaries and home office staff have to manage is the unpredictability of the timing of loan origination and repayment. Like that is absolutely a risk to the company.
Yeah.
They've got to have enough capital on hand in order to be able to meet those guarantees. And it's not just policy loans, right? It's also outright policy surrenders, partial withdrawals, dividend distributions. The companies have to manage that. And so you're not helping anybody by making their job harder, right? By telling customers, by telling clients and policy owners to go wear out the life insurance company, right? It's not it's just like how in equipment financing part 4, the what's causing the cumulative net outlay to increase, what's causing cash value to go up is not more and more loan activity.
Right.
It's the premium payment. Like there is nothing special. There's no magic in policy loans. Now, is the cash value there? Can you go get a policy loan? Are there legitimate reasons having to do with the ease of access and the efficiency and the true interest cost? Are all of those reasons there to justify and warrant going and getting a policy loan for a legitimate need for capital? Yes, but that bakes a lot into the notion of what a legitimate need for capital is. And a legitimate need for capital is not needing to go get a policy loan so you can go get your money out because you were talked into a giant premium by the guy selling the dump in big time, first year 1, year 2 premium payment.
Wait. And then because it's a direct recognition company, go collateralize it.
Right.
Oh, no. I mean, it's part and parcel. It's like the same stuff.
Yeah. Yeah. And these companies that, there are, when I refer to IBC friendly companies, these are organizations that have practice at this, right? Who know what's going on, who understand what loan activity on a block of whole life business looks like. And so it's no wonder that there are other companies who are not IBC friendly because there is extra attention must be paid to that style of business, to what loan origination and loan repayment activity looks like. Right? And if your number cruncher people don't know that, then it's going to look unpleasant, and you're going to get memos from companies saying, "Don't send us the business, or we'll cancel your contract."
I love that. Big Blue paying a 6% dividend, whatever. Right? Big Blue. Okay, and I believe it's mutual life insurance companies against the world when it comes to finances at the you and me level. Okay, here you have Big Blue paying a 6% dividend and whatever their loan rate is at 5%. Then on brand new policies where, there's a loss of liquidity in whole life, because all of the cost of putting that business on the books, and it does cost a life insurance company money to put the business on the books. They got to pay not only the commissions to the agent, but they have to have cash and cash equivalents to all the liquidity that is guaranteed by the contract. And then they got to pay for everybody in the home office, and they got to pay for all these expenses. And I'm just saying it's weighted to the first 2 years. Okay, so then you overload the policy with PUAs and 85, 90% of the premium, quote unquote, to the PUA. And here, Big Blue's got to pay that big old dividend, right? That's artificially supported. It's supported. The dividend is supported by other, areas of the enterprise. Okay. Is that a problem? Not necessarily. It's not good whenever you sell off your most profitable divisions that have historically supported the dividend. You've sold them off, and so you still got to support the dividend. And then you have a loan rate at 5, and then you have these yahoos sending in, big first year premiums and then immediately borrow. I wouldn't like that either. Right. So Yeah. Oh, okay. If you're paying 6, you're charging 5. Is this on the dividend? And just because a company pays a 5, 5.5, or 6% dividend doesn't mean you're going to see a 6% rate of return in the policy. I know it's kind of like that's an early misunderstanding or an abused type of marketing promotion. It's like selling a life insurance policy off the dividend, and the guaranteed rate, right? Oh, back in the day when the guaranteed rate was 4 and the dividend was 6, that's 10, but you put 90% to the PUA, and then you're still a net loss of 10 or 15 or 15% in the first year of cash values to premium. So just going through that math, I wouldn't want all of those poorly constructed policies in the beginning, because now you got contractually the client has a right to borrow against those high early cash values. So it's stressful to the company. Do I feel sorry for the life insurance company? No, I don't. But then if I continue on that construct, when you have the blended PUAs, the death benefit is ultimately going to go down. Just as a side note while we're talking about these. So the long-term liability to the insurance company, it looks pretty good. If the death benefit is lower at natural mortality than what's illustrated in those early years, it's like, So I don't have a bleeding heart for these life insurance companies that say, oh, there's too much pressure and spread compression and blah, 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 whenever they're cashing the checks, right? They cash every premium check that comes in. And then that very construct that they're whining about is beneficial to them in the long run. So, and then too, the idea that borrowing money against your cash values makes the policy more profitable or more efficient. Just what you said earlier, you're wearing out the home office, the loan request and paper. And I get it that, a lot of young people don't even use checking accounts or checkbooks or, everything's online, which you can go online and request loans and make loan repayments and all that. That's fulfilled by a service individual in the home office. They don't have drive-through windows. They're not a bank. They don't have tellers. It's a service function. So,
yeah,
the systematic, purposeful, with intent, capital formation is the solution. Right?
Yeah. I want to make a point too. I was looking here too on this idea of the mutual holding company, that has progressively replaced the pure mutual, right? Where we add and the way I've explained it to clients is that we add in a layer of dexterity and financial resilience while preserving the essence of mutuality, which is policy owner participation in the dividend. Right. So under a pure mutual, the entire enterprise is totally and completely owned by individual policy owners. Of course, I don't have to tell you this, but for you listening. And then whereas a stock company, pure stock company, is owned by stock owners, people who can buy and sell shares of the entity on an open market. The mutual holding company structure consists really of various legal entities, but the idea is that a very large but minority position in what was the pure mutual is then owned by a parent group, essentially, or a parent company, right? And the policy owners still maintain, in order to preserve this essence of mutuality, the policy owners still own a majority of the issuing life insurance company that sells the policies, right? So a policy owner at a life insurance company that operates under the mutual holding company structure still has mutuality. They still have a contractual right. They still have residual claimancy to the generation of surplus at that company. So when the company does well and has more on hand than it did when it started at the end of the year, that surplus, some share of it still goes to the individual policy owner, right? There isn't stock. You can't go out and buy a position in this company. So in that sense, mutuality is preserved. But what the mutual holding company structure allows is to give access to this now subsidiary issuing life insurance company to a more capitalized, larger financial entity, which of course is going to have other companies, right? So there's baked into this idea of the mutual holding company structure is the idea of diversification. Right? I think some people who have listened to IBC, listened to this podcast, they get into this mode of whole life insurance companies, and they think that that's all that's out there. When in fact, like the whole life business is just one component of a broader array of financial services and products that are provided by these other companies that participate in this mutual holding company enterprise, right? So things like term and universal life and annuities and other sorts of financial products, some of which are very profitable to the company, in effect, help or assist or provide backing to someone who practices IBC with whole life, right?
You mean those other enterprises add to the bottom line and potentially increase my dividend because it increases the profitability of the company? Is that what you're saying? Is that what you're alluding to, sir?
Yeah, that's one aspect. And then also just as a backstop to provide capital should be required.
Right. So, going back to it costs money to put these life insurance policies on the books in force, right? And you have a medium-sized company that is growing exponentially, right? For whatever, they have great products, they have great service, they have great salespeople, and so the consumer, the general public is buying a lot of their product. It costs them money, right? And you can have, you can have a 10, 5, 10, 12, 15, $20 billion company that could have some pressure because that's still not enough capital to put these new policies on the books, right? So, and if they're a mutual company, they can't issue stock to raise capital. They can go borrow money, right? Surplus bonds. I wonder how many, I don't even go there, how many. All right. So with a mutual holding company arrangement, this larger entity has capital. You can't jump over that. That's a big deal. So in a mutual holding company arrangement, you could have a really good company that can remain really competitive and innovative, creating products that are profitable and meet the demand of the market. All right.
And combat the overall consolidation and financial repression that's happened since 71.
Yes.
Right?
Yes.
And that's why the pure mutual is and has been on its way out. A lot of the only pure mutuals remaining are the very large ones, and other companies have come under the umbrella of a mutual holding company structure in order to maintain the necessary capital to stay, like you say, to stay competitive in this environment.
And profitable, and then, it could also, like anything, go awry. There have been some really great mutual companies over the years that have done financial shenanigans and, gone into receivership and liquidation. And, this is an okay, let me point out that every life insurance company that issues contracts, which is what a life insurance policy is, or an annuity, right? They're contracts issued by life insurance companies. And the guarantees made by that company in these contracts are backed up by their claims paying ability. That's where the guarantee is, period. Secondarily, right, there's the guarantee associations, with each state. There's a secondary guarantee, right? So a life insurance company cannot go bankrupt. Can't happen. They don't go bankrupt. They go into receivership, either liquidation or rehabilitation. And that's, controlled by the Guarantee Association, the state where your company is domiciled in. Of course, oh, wait, you're in Texas, I'm in California, I'm in Wisconsin. I'm guaranteed there's a certain amount of guarantees provided by that state, right? And these companies, have to pay. No, you, the consumer who pays for everything, is paying for these guarantees. Right, because the life insurance companies have to pay into these associations. And I'll take a side note on that. I think I've mentioned it before. Last year, I was at a life insurance conference and with a big life insurance company, and one of the top officers in conversation, it was last year, 2022. They had made their last payment to the Guarantee Association fund that bailed out Executive Life out of California. And this company was not domiciled in California, but they had policyholders in California. Okay. And so the Guarantee Association is, ran by the states. And, I just have to point out that, excuse me, your state's broke, sir. Your state's broke as well. They don't have any money. Now, they do have the power to tax and all that. But there are secondary guarantees to life insurance, and it's $100,000 in cash value, $300,000 in death benefit, and it's $250,000 per annuity contract. So, it's just like the FDIC. You can insure up to $250,000. But to prevent contagion or to take care of their good old boys, they have on a whim, they could say, no, we'll guarantee above that, or we won't. Or we'll guarantee it for you big banks, but not for the little banks. They can do whatever the hell they want to do. Yeah. And that's exactly what they'll do. Number one, they'll take care of their own that they want to take care of, and they'll eat the ones of their own that they want to get rid of.
Yeah.
Okay. So go ahead.
I was going to say one response I've seen from after the bank run stuff is people calling for FDIC to just eliminate the idea of an upper limit on how much they're going to insure. And so great. Let's call for, more government programs to solve problems created by government programs. And
that's exactly what that is.
Yeah. And I think a lot of people, maybe not a lot, some watching this or listening to this may say, well, $300,000 in death benefit, $100,000 in cash value. What are you talking about? I got more than that. I started with more than that. What are you talking about?
Exactly.
And I get it. And the urge to want the government to protect you should be observed and excused, right? It's this fear that, it's the company. What's providing the guarantee is the claims paying ability of the company is somehow shaded or bad, that we want a government guarantee instead. No. The greater the government guarantee, the more aggressive and risky the companies become.
What? Moral hazard leaves whenever you got 100% guarantee?
Yeah. So if that, it's the seen and the unseen, right? The unintended consequence of, we should have more government protection means that the source that would ostensibly cause the problem in the first place would only get worse, right? So the way to address concerns over guarantees, the availability of value in a life insurance policy is with proper due diligence, and then to be aware of the ways out, right? To be it a 1035 exchange or what have you. And look, there is also no perfect solution. The future is uncertain. Nothing in this life is guaranteed other than that it will end. And I often find myself having to bring clients back into that perspective that, look, at the end of the day, the federal government could declare war on, the state of Texas and shut down any business operating in any state it wants. Like there is no perfect answer here. You want perfection, you got to read the Bible, right? All we have here is a limited option set from which to select the asset in which we might capitalize. And that's if you agree that it's a good idea to systematically accumulate concentrated capital. And if it is, then we have a limited, practical, realistic set of options from which to choose. And a proper advisory conversation, as we've discussed more and more recently here, should consider the nature of the company, how long they've been around. I mean, I had an individual come to me, had just signed on to become an agent with an IMO, and there was a very brief glimpse at the nature of the carrier standing behind the IMO. Come to find out, she ended up with a good company, but there was no awareness of the context from the get-go.
I love it when the IMO is owned by the life insurance company, and none of the agents know that in the beginning. They might figure it out later.
Yeah.
So, I love it.
But that should be part of company selection should fuel the selection of advisor, but then the design of the case in the first place, because the terms and conditions vary company to company. So there are things that can be done, and an individual who embraces the responsibility to seek out or perform that due diligence themselves, that is the answer. The answer is more individual responsibility. The answer is taking on the responsibility yourself to secure your own situation. I mean, so many of and I always love it, right? Whenever there's a crisis, a government crisis, financial crisis, is what's the government going to do? No one ever gets up and says, gosh, there's a crisis. What am I going to do? What am I going to do to protect my people, my future? How am I going to think differently, right? Which, by the way, is all you can control anyway. Right. But no one ever, we don't want to, what's the government? What's the collective? We need to do this or that to this or that government program or authority. And of course, it's always more that's only going to exacerbate the underlying problems that caused the issue in the first place. And we wonder why there's this cascade of centralization and consolidation. Like, It's
like, bring it on, man. It's oh my goodness. The mere idea that, there's a couple of things. It's like the conservative, I've seen some of the writings of conservatives. It's like, well, you're just being more communist. You just want more communism, more socialism if you want to take away the limits of guarantees and make it unlimited guarantee. They caused the damn problem in the first place. Yeah. More government is always like the cry, right? But it just who cares what the limit is? At the end of the day, who cares? If they want to collapse the banking system, by God, they're going to collapse the banking system. Yeah. You go grab all the money out of your bank. What are you going to do with it? You better give them plenty of time if you got over $250,000 in there to gin up
the cash.
You got it. I was talking to a gentleman the other day, client, and we were talking about this, and it wasn't that long ago. It wasn't recent, but it wasn't that long ago. He went into withdraw. It was some ridiculous amount, like $5,000 or $6,000 or $7,000, and they told him to come back in 2 days.
Jeez.
And that was not related to this, right? Mm-hmm. Timing. Okay, so you're going to pile up money, in the mattress, cash, right? Oh, well, what happens when they say, there's a currency change, or we're not going to use those $100 bills? It wasn't, I think it was last year that the EU got rid of a $500 euro note, right? Well, people have been hoarding them for years, right? And they tried to get rid of it a couple of years ago. They started the process, and the window closed, sometime last year. You had to turn it in. So you want to stuff, a bunch of $100 bills under your mattress? Or how about go buy gold? You can get an awful lot of gold in a very small space, right? And it's a legitimate question, that Nelson used to ask all the time. It's like, wait a minute, you're going to give me your gold, right, for my worthless dollars? Help me out. Help me understand that, right? And then if I have... maybe I got a gold bar, maybe I've got a $20 gold coin, whatever it is, and I want to buy $5, I want to buy a $20 haircut. Am I going to chip off $20 worth of gold from a 1 ounce gold coin?
Yeah.
And if you withdraw your money from the life insurance company or from the annuity, from the life insurance contract, from the market, wherever, whatever, it's like, what are you going to do with it?
Mm-hmm. Yeah, the problem of bad money, the solution to that isn't no money. Like there's going to be money. Money is just the most saleable commodity, the most saleable good. I know money's not a commodity money anymore, but it's the most saleable good.
Crypto's real money. What are you talking about? It's divisible.
Yeah, and I mean,
it's non-inflatable.
And there's all this and I've probably contributed to it in the past, the hostility over cryptocurrency. At the end of the day, I don't really care. It's not in my control anyway. The money's going to be what it's going to be. The most saleable asset, the most saleable good is going to be what it's going to be because that solves the problem of the double coincidence of wants. It facilitates exchange. There's going to be money. It's either going to be privately issued or it's going to be government issued, or there's going to be a combination of the two. And there may even be competing monies. And I think that's probably where we're going, is a world where there are
where
there are competing monies that circulate side by side, some illicitly, some explicitly. At the end of the day, and here's the major freaking distinction that I'm just going to keep as the subject of my dissertation. I'm going to keep on this, is that what the money is and how you build capital are two separate things. Like capital, the financial or monetary value of an asset, is a distinct thing from the type of money itself, right? There's going to be stuff worth money, regardless of what the money is. My point from a financial and economic strategic perspective is we want more of the capital. We want more of the monetary value, regardless of the particular denomination. The answer is more, right? And because sometimes people say, becoming your own banker, IBC, it's so good. How is this legal? Aren't they going to come after it? They're going to come from, are there more restrictions in the vein of modified endowment contracts? And my responses to that are, one, they don't understand this, right? Because the idea of systematic capital, first of all, it's the opposite of what the federal government does.
Absolutely.
Right? And then all of the bureaucrats and the professors who shill for the bureaucrats all collect a state check. So it's not like they have the responsibility to go and accumulate their own capital anyway. Like the only way they would develop an awareness of this is indirectly, right? So there's a gap there. I'm not sure. I'm not even willing to grant that they understand. There are people in finance who don't understand that, right? So it's like, there's a theoretical gulf, number one. Number two, just empirically speaking, you've never heard of a run on a mutual insurance company, right? IBC, when people ask me what I do, first of all, groan. I do the infinite banking concept. What is that? No one's ever heard of this, okay? By the way, approaching 10,000 subscribers on the channel, that's cool, but it's not 10 million. It's not a million.
Because we don't pay to promote.
But my point is that this is still small. Yeah. And so it's empirically at this particular time and place, it's still small. Theoretically, the idea of accumulating capital just doesn't make sense to people, right? And of course they don't, because there's all still these more and more contributions to tax qualified plans, right? And there's no awareness that, like I talked in my think tank talk in February of 23, there's no awareness that conventional financial advising is subject to the business cycle, right? all of this has to do, like the idea that I'm going to take responsibility to accumulate capital that I own and control and can get access to when and where I want to use for what I want. That hyper narrow, hyper individualized perspective is so counter to the culture that it's not even on the radar. Right? It's all about what's the tax qualified plan? What's the government going to do? So my point is, there is this peace, and Nelson used to say it's such a peaceful way of life. There is this peace that should come to somebody whose capital is systematically accumulated in IBC style whole life policies that other people don't understand. Like the opposite of an implication of the Lone Ranger syndrome is like, yeah, you may feel isolated and alone, but when the entire crowd is running off the bank crisis cliff into the tax qualified plan crevice, you can stand there knowing, yeah, I'm good. Of the limited, imperfect, plagued by the mankind's fallen human nature options, I went with the thing that has the best historical track record, where the economics make sense, where there's no fractional reserve banking. I'm not contributing to the business cycle. And I've got a contract that's the result of private, mutually agreeable exchange from a company that's nearly or maybe older than the country itself. It's like, how much more secure outside of the Garden of Eden would you want to be? And I'm not saying that, look, Ohio National went under. They demutualized. This is not perfect. There is no perfect solution, but there are ways out. There are things one can do should those extreme events occur. And let's just say, look, if you go to 1035, you don't have a right to 1035 exchange. You don't have a right to take one policy from one company to another company. You have to apply for a policy with the other company. It's not a perfect solution. The new company would be taking on a risk that they previously did not. And so they get to determine whether they want to do that. Well, it's okay to be healthy at that time, right? It's okay to not let yourself go or whatever it is. Like, it's okay to also take personal responsibility for your own health as best as possible.
Wait. If I'm going to buy life insurance in the future, I might be aware of how big my waistline is or what my blood pressure is. I mean, I might like focus on the greatest asset, the investment that I would ever be exposed to myself. Yeah.
All that personal responsibility. OMG.
I just just tell me where to put my money.
Yeah. What
Ohio National program. Look, Ohio National didn't go under. They demutualized. So, Canadian private equity group.
Oh, Canadian private equity
could buy them because they've got all the capital, from all of these other hedge funds, and then they have. Let me see. I think they're managing the Canadian Teachers Retirement.
Ontario Teachers Retirement Association.
Yeah, they got to put all that money somewhere, and mutual companies are just not that profitable, so they had to demutualize so they could do a stock company. So they, instead of a 6-7% rate of return, they're shooting, of course, for the 12 and 15% rate of return. So I don't know, but I'm sure all their products are now going to be universal life and.
Oh, the new product release, indexed whole life?
I saved an article a month or so ago, but I hadn't gotten around to reading it because I just wasn't ready to throw up in my mouth, so I didn't read it. Sorry, I apologize, but there's some. Just like you, we all get inundated with information. It's like this banking, that banking, and all the narratives going on. And it's no different in the life insurance world, right? We get tons of information, and it's just like, oh my gosh, you're trying to sort through it. Here we go again. Yeah. How much time do I want to waste on this? But there might be some little nugget in there that you didn't know. Did you read the article on the indexed whole life?
It's been some months ago, but yeah.
I'm like, I know what I need to know, and I don't know everything, and I don't have the arrival syndrome, but I know what I need to know about that life insurance company. They went around the country, tried to sell themselves to every legitimate buyer out there, and every legitimate buyer out there said, no, thank you. Why? Because they could do their due diligence and look at the risk on the books in the future.
Yeah, and this was reflected in Comdex scores. I mean, you didn't have to be, an oracle to see that. If your condition was deteriorating. If you know the business, like if you know the life insurance business, from a mutual whole life insurance company perspective, everybody can look at their little block of business. That's why all the that's why all the life insurance companies said no thank you, that they tried to sell themselves to. Now, one did buy them, and I'm not going to talk about that, but anyway. Yeah.
So, I would say that the financials of the company matter. I would say that your understanding matters. And I would say that your actions matter the most. To get a good education, in my opinion, you've got to be able to recognize some noise. There's a lot of good stuff out there on the internet, but there's an awful lot of jank stuff you should step over. But go to the source, okay? Begin at Nelson Nash's first book, Becoming Your Own Banker. His second book, Building Your Warehouse of Wealth. And then his 6.5-hour seminar that's available digitally or on DVD. And I know that, we're in the age where I don't have a DVD player. I bet your children have game boxes. I don't know. You can play a DVD there. But you should own that. All right, you should own these two books, and you should own that access or the DVDs. 6.5 hours. That's a solid foundation. Then I would throw in How Privatized Banking Really Works by Dr. Robert Murphy and Carlos Lara. And there's a lot of other stuff out there. Mr. Griggs will get around to releasing his book, which we're all looking forward to. But a foundational educational understanding. And you can skip over, in my opinion, if you read these two books, and I get it, even Nelson's first book is on Audible. It doesn't exactly match up chapter by chapter as the printed version, the 5th edition of Becoming Your Own Banker. But It's only 92 pages. You know, the blue book, the Building a Warehouse of Wealth, is not that thick. It's okay, especially if we're talking about you can read this, or you can read all the articles about all of these collapsing banks and the collapsing cryptocurrency exchanges, right? I mean, it's okay to read this. Take your time, even if you don't like to read. You're a slow reader. I'm the slowest among us. And it will inform you whether you even want to consider this idea of becoming your own banker, right, for yourself and your family. Yeah. And then once you have that solid foundation, in my opinion, you'll be able to vet the noise. That doesn't sound right. That doesn't sound right. That doesn't sound right. And you could probably tell somebody why it doesn't sound right. Not that they'd be interested in hearing. It's like
there's a lot on the why study, the idea of why study economics, like why care. It's all esoteric, can't understand it, it's corrupt, blah, blah, blah. Yeah, all of which, fine, true. But understanding some economics is the solution to times like these. The fear, the lack of economic understanding creates a vacuum that fear fills. Right? If there's not if you don't have clear context and clear orientation, then that creates a theoretical vacuum. And fear loves that, right? And so it'll make someone feel scared, feel uncertain, feel inadequate, and all of the things that come with that, which is everything on the, anxiety and psychological terror and all of that kind of stuff. And so, look, I'm not telling you to go read Human Action by Mises. I mean, if you could do that, that'd be good. Understanding Money Mechanics by Bob Murphy is a great little primer. But we harp on this all the time about reading Nelson's Becoming Your Own Banker, and you've used the example before of decoder lenses, like the little red and blue glasses you'd get in the cereal box. Yep. It's like it helps you see through. This is what we're talking about. Like if you understand the basic principles of don't be afraid to capitalize, of the value of taking responsibility and thinking long range, and the whole idea of capital that I harp on. Like if you understand those core fundamental principles, then even in the middle of an information war, even in the middle of a financial repression campaign, even in the middle of the onslaught of information from the internet, you have a sorting device. You have something that can help you sift through to get to what you personally, individually need to do. And that is the value of developing this conceptual understanding. It's the value of knowing some economics. It's the value of reading Nelson's book, Becoming Your Own Banker, rather than capitulating to the fancy marketing schemes.
Yeah.
Right? If you're just a number that happens to be participating in a click funnel in order to be led to a sale, so that because someone's making it easy for you, you're missing out on the thing that will equip you for the next crisis. Because as we said earlier, the crises are a feature. They are not a bug. They are a feature of the fractional reserve banking system.
Absolutely.
So this is going to happen again.
Yeah.
Right? And it would be okay to be prepared at that time. And in reading Nelson's book is one small, little, but extremely powerful way to prepare yourself for that. And all of, I would say, I would stress again, all of this is in the context of the broader objective, the particular selected, differentiated objective of deciding to systematically concentrate and accumulate monetary value. Right? That is a unique objective that people generally aren't doing. Right? It happens on accident or in piecemeal fashion, if at all. Right?
Well, and they may think, well, I'm contributing to a 401k. I'm contributing to my IRA. Yeah. And so
exposing it to systematic planned loss.
Yes, but it's easy to mistakenly believe that I'm building capital.
Yeah. Well, here's a good test.
I mean,
explain, like, for the individual themselves, explain that rationale, explain the objections to that rationale, and explain the rationale for the objections. If you can do all that, then maybe you can actually make the case that you have taken responsibility to own that decision. But if you can't do that, if you can't explain the reasons why, the reasons against, and the reasons for the reasons against, then it might be an indication that you've just accepted the noise through osmosis.
That's exactly right. You know, back in the day when I first started my little career, and I know I'm not that old, but it was, you know, buy term and invest the difference, you know, from a company, you know, where A.L. Williams got that idea, and then they didn't even originate it. But it was, the invest the difference was into mutual funds, right? And back then, this is how far back it goes, it was an 8.5% front end load. That's what they were. You know, today it's like, oh, we'd fall out of our chair with a heart attack. How much? Right. But they pay the 3, the 2.5, the IBC shares. I mean, they pay egregious fees over the life of, you know, a mutual fund contract and jump smooth over that. But it's I forgot where I was going to go. Wait. Yeah. I forgot where I was going.
That's okay.
No, I don't want to jump over that because I thought it was good, but just the systematic formation of cap. No, they think that, okay, so I'm doing the 401k, I'm buying mutual funds, you know, everybody else is doing it. And then this is where I was going. It's like, you mentioned the infinite banking concept, and it's like, well, what do you mean? What life insurance? Can you explain that to me? I could, or you could read and educate yourself and not depend on me and my explanation, right? Well, back in the day, it was the same thing. Well, what the hell is a mutual fund? What do you mean? You know, what is a mutual fund? How do you explain that? And it was like, you had to explain what a mutual fund was. Well, you know, they're like looking at you in a daze. Well, now everybody buys mutual funds like it's no big deal. But can you explain a mutual fund? You know, and I'm sure most of you can. Get your mom to explain a mutual fund, all right, where she's got all her money. My whole point here is, if you want to explain the 401k and the contribution, if you can do that, well, if you can explain a mutual fund, if you can explain what you're doing financially, it's good.
Yeah.
You know, you should be able to do that. And if you can't, then maybe, so instead of relying on somebody's explanation of the infinite banking concept or life insurance, and I love it because it's true, most people's understanding of life insurance is based on someone else's misconception. Then you dive off into this idea of infinite banking. There's a zillion names out there, and they all say they're doing whatever Nelson did, mentioning his name. You can string the IBC together. And so they're telling you, you know, you got to have a high premium or whatever it is you got to do. You can vet that. Whatever they're telling you, you can vet us. Right? You can vet what we're saying, and we're telling you where the material is to go vet us. Right? So
yeah, or fill out the form, and I'll do a call. 20. I know you will too.
A 20-minute call with anybody.
Ask your questions.
Yeah, and wait, did you bring that up? You do too. I'm sure. Get emails all the time, and I respond to every email. You know, we're responsive, right? But I love these emails that come in and it's kind of like, you know, now I don't know how you operate, whether you're a salesperson or you get paid by policy or you do consulting fees or, you know, whatever that initial is. And it's like, of course you don't. You've never asked, right? I tell people how I get paid. But they start with that sometimes, but then they want to get to their question that they have a dire need for an answer, right? But they cloak it or begin with, you know, I don't know if you do this kind of work or whatever. Do I have to be a client for you to answer my questions? And it's heart-rending.
I'll pay you for your time.
Right. Yeah, I'd be more than happy to pay you for your time if you do consulting work, but if you don't, maybe you can refer to somebody who does, or maybe you only get paid by the policy. I'm not sure how you work, but I had I have these questions that, burning down the house and I need an answer to. And it's like, just ask a question. How about we start there?
Just get to the point. Yeah.
How about we just say, hey, this is where I'm at. Can you help me? Yes or no? And it's like, yeah, probably can, whether you become a client or not. I mean, how much time do you spend with people who don't become clients? And you don't have to answer that. I can tell you it's a lot, right? And the same here. And my whole point is, you can educate yourself and you don't have to be dependent upon other people's explanation of Nelson's work. You can go and find out what Nelson said about the infinite banking concept. I mean, it's there. You don't have to rely on my interpretation, Ryan's interpretation, or anyone's interpretation. It's there. You can find out for yourself, and it's worth it. It's just my encouragement. Which I hear all the time too from clients, prospective clients. Like, James, I didn't even know that 6.5-hour DVD series was available. I've got 3 policies. I'm paying X number of premium, a lot. And then I read Nelson's book, or I've listened to Nelson, and it's like, oh my gosh, I don't think I'm doing what, I thought I was doing. So
that happened 2 times this week. Get in touch. I've got however many it was, 2 or 3 policies, direct recognition, blended term PUA rider. 10% of annual outlay to the base, showing the blended term carried through like age 50. And I'm like, and then it's uncomfortable.
It's very uncomfortable. You tell them what they have, and it's not good, bad, or indifferent. And talking about 1035 exchange, it doesn't automatically, just because you have a policy that may not be what you thought it was when you originally purchased it.
You didn't know the options at the time.
Yeah. It doesn't mean that you've got to burn that down and start all over. Okay. And then too, I want to go back to this is, we all make decisions based on the information that we have, right? And sometimes we have bad information, right? But this is what we have. And no question that could potentially be a mistake. Or we make decisions based on emotions. That's what fear, right? Fear is an emotion. And if I'm out of balance on my emotions, fear or greed, I'm probably not going to make a good decision, right? So the information that you consume is important, and it's worth waiting to get the information before you make a decision. I don't know, you've had 2 this week. I've had exactly 2 this week. And just think of how many people didn't call, right? And it's like, you don't have to do anything right now, right? It isn't like, oh, the banks are collapsing, I got to get all my money into a life insurance policy immediately. No, you don't. Take the time to educate yourself is my encouragement. And this is how that Nelson's 2 books, his 6.5-hour video series. It's like, I see, I don't think I shared it with you, but, and maybe we'll talk about when
everybody's not listening.
No, I'll talk about this. I had a prospective client, he's several policies, and it's like, I didn't know this, and I didn't know this, and I didn't know this. And we're just telling him what he has. And, this is what you have, and blah, 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 blah. And he's like, and I was even paying the additional cost, the monthly cost to get to that entity or the entity that provided this.
No way.
Yes.
A subscription fee
monthly.
On top of the.
Yes. And then still couldn't get his questions answered. I'm like, so these people want the information. I'm just telling you where. And I'm just saying for less than 2 months of that subscription fee that young man was paying, you can have all of the foundational information. Now you got to spend the time to go through it. It's not going to be spoon fed to you necessarily. Yeah, I didn't tell you that, did I?
No, you didn't.
And it's just
can't wait to find out who it was.
It's heart wrenching, So, but look, I'm a capitalist, so you spend your money, you spend your time to vet this concept, right? And then call someone who knows what they're doing, who's not practicing on you. Okay.
Yeah. And my thing is when people say, "Oh, you're saying that you're just marketing." My thing is that
you're marketing right now. You do a podcast.
I'm always marketing. I just
you're a machine.
Capitalist. So I must be marketing. My point is, though, the more deep point is whether you agree with me or not is beside the point. I would just rather you have a rationale for what you're going to do, right? What bothers me is when people end up with stuff that they don't understand and they don't know why they got what they got. And why would they have known, right? They weren't told that there were options in the first place. So yeah, here I am telling you options and saying that I've got a preference for this over that. And then maybe that sounds like marketing to you. But what it is improving the resolution of the context, developing a higher definition understanding of the landscape. That's what it is. And if you want to take a path that's different than mine, go for it. But know where you're going and why you're going that way, right? So do I think that, the method I use to apply the principles that Nelson taught in your individual life are better than a lot of what's out there? Yup, I do. And I can explain why. Right. But that's my rationale. Maybe you want, going back to this idea of what's the right design or the right policy or the right company no, there's value alignment or there's not value alignment. There's embedding what Nelson taught in your own application of his principles or following a marketing plan. Those are the alternatives. And if you want to follow the marketing plan, great. Leave me out of it. If you want to do what Nelson taught, we can do some work and it'll produce the kind of natural, organic, peaceful financial life that's possible for us in this fallen world. Not perfection, but a dramatic improvement on what other people are going through. All these companies that losing money because they had giant bank accounts with these bankers, all that capital should have been in life insurance. And they should have been using the banks as gophers to fetch money from the company and give it to from the life insurance company to give it to the corporation to use for what they needed. Right? And the individual owner, they're all publicly traded companies. The individual owner of the corporation that is the customer to the bank should have been the one controlling all of that, rather than being dependent on the commercial bank and keeping an account balance in excess of FDIC insured levels. The FDIC insured level isn't the point anyway. The capital should be accumulated in private assets that you own and control. That should be in whole life, period. And if there's a problem with getting from where you are now to where the majority of your capital is stored in life insurance, that is a problem of logistics, not of principle, right? That is a problem of a matter of time, right? That is a suggestion that a process should have already been started. And one that should have already been started can go ahead and start now. Because as we said earlier, this will happen again. And if you're of an age where you're going to, likely be around for the next financial crisis, it's okay to prepare now. And in fact, you might need to, because you can't go dump in a bunch of cash into a whole life policy in a tax favorable fashion. It's got to be done over time.
Look, there'll be somebody out there that says, no, yes, you can. Let me show you how. Oh my goodness.
Anyway, I feel better. I hope everybody else feels better.
It's like therapeutic in there.
It is. But that's how I feel about bank failures. This particular episode of bank failures, it's confined to the particularly risky segment of the small and medium-sized market, where a vast majority of bank capital was in treasury bonds that got clobbered in value when interest rates spiked. Doesn't help that they had no risk management. Doesn't help that they literally had no risk manager for 9 months in the preceding year. Doesn't help that they were severely concentrated in one industry. Like, there are other confounding proximate factors that contributed.
They weren't over leveraged. It has nothing to do. Like, the fractional banking system is just fine. They just didn't have a risk manager.
Yeah.
There's some capital calls.
Regulations weren't good enough.
Oh, yeah.
Right? You got to have better regulations. Yeah, because that's worked out so far. Boy. Anyway.
Okay, thanks for listening. I'm good.
Before we end, the problem is what you always say. The problem is the problem.
The problem is a problem, whatever it is, and there's always going to be a new problem, couched in a new light, new story, new backdrop. Same thing over and over and over and over and over and over. Yeah. The solution is the premium. Period. The premium is the solution.
I'm happy.
Okay.
Bye, y'all.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.